Welcome to Sapient Advisors Office Hours. Today we're exploring how spatial risk systems is reshaping the way we understand portfolio and location-based risk. So whether you're in data science, portfolio management, or risk strategy, today our conversation will show how connecting geospatial data, environmental signals, and market context can transform how we see exposure and opportunity.
Thanks, Sandy. Welcome, everyone. We're very excited today to have two very special guests joining us.
Yep.
Alex Vengernovsky, who is the Chief Science Officer of Spatial Risk Systems and co-founder, as well as Raymond Clark, who is the co-founder and Chief Product Officer of the firm. And basically, we will be having a chat with them right now about the firm and how they got started and what they're doing, and even a demo. And Christine is going to be manning the LinkedIn Live comments. So if you have any questions, please drop them in there. She'll be sending them our way, and we'll be taking questions throughout the show. Thank you.
Awesome. Great. So we're thrilled to have you guys here. I think, Raymond, let's start with you. Tell us a bit about your origin story and what inspired your focus on spatial risk.
Oh, thank you. I essentially grew up in the data space when I started my career, building products around that data to track the performance of assets and portfolios. There probably wasn't a single, let's say, aha moment that brought me here, but a series of events that led me to understand the inherent risk in locations. And if locations are not understood properly, they can have a negative consequence on your assets or your portfolio. And yeah, so I'll leave with that. But that's basically what it is. There's I can think of a number of scenarios where I've the fundamentals were correct, but loss was taken because of the location.
Right. Adds another layer to your thoughts. And Alex, you bring a technical and more product perspective. What kind of problems does your platform solve for financial and risk professionals?
Well, don't get me started. So let's, what I think is the right thing to do, let's go back before we go forward, right? So I met with Ken Zokol, who is our CEO, 5 years ago. I was a free ranger after leaving Bridgewater Associates, and one of my vendors connected me with Ken. Ken had an idea, and I like the idea because it allows me to work with data, which I love, and it's a significant challenge. It's a huge challenge, actually. And the idea was around data about physical assets. I would call it one of the last big gaps in the financial data ecosystem. So everybody knows where to go and get pricing information, terms and conditions, fundamentals, all this kind of stuff. It's expensive, but it's a commodity, basically. It's expensive commodity. But when it gets to the knowledge of where the physical assets that underpin those investments, where exactly they are, what they do, who's working there, what kind of environmental, climate, and bunch of other conditions exist around assets, it gets very difficult very quickly. And that's a challenge that we wanted to solve. So as a basis. Now, that's how it started. But then we needed to do something. So we started collecting and organizing the data, going into our core competency, which is ability to understand, quality control, organize, govern the data properly so it's usable. Otherwise, it's just a collection of some poorly understood, poorly described pieces, numbers. And that's what we focus on literally first few years, building a foundation for what we call now is a spatial knowledge. So what is spatial knowledge graph? At the foundation, what I would call core domain is information about physical assets. Warehouses, factories, manufacturing factories, steel plants, steel producing plants, mines, airports, ports, terminals, hospitals, universities. It's a tangible pieces on the ground, which I would call the foundation of our civilization. You take them out, you don't have civilization. So all those financials numbers just disappear outside of obviously Bitcoin and other wonderful things. That's a foundation, that's a core domain. We connected to the core domain bunch of other domains. We created a full taxonomy describing the activities at those assets this taxonomy is connected to the industry standards such as NICE, SIC, government classification of products, and things of that nature. So it's connected to the world, connected to how people in other areas think about activities, but it has a much bigger scope. So it covers practically everything. We created a very deep geospatial classification that allows us to navigate different levels from census block up to the county, up to the administrative divisions and of all kind of flavors. That are also very helpful in aggregating the data. And in addition to that, and what is really, really important, that gives a lot of context to the data about physical assets is different domains, environmental domains, weather domain, crime domain, socioeconomic domains of data describing what the socioeconomic makeup of the area where those assets operate and exist. Demographics, industry makeup, all those things are very nicely organized and connected. So basically, every data point in our graph is connected to dozens and hundreds of other data points, allowing to build the full picture of the asset, of what's going on there, some of the KPI, and all the environmental and socioeconomic conditions that exist around this asset. That was a long spiel.
And I think also you guys have now, you do public and private companies, right? Yeah. And you link all of this up to the securities as well that are attached to these physical assets.
Yes, I kind of omitted the other key components. In order to make this data usable in the financial investment analytic context, you need to, again, bring connect it to the real world and how people think about those assets. So our assets are connected to their owners, corporate owners, to the global ultimate owners, entities of that nature. And those entities are also tagged with industry identifiers used in trading, such as ISIN, SIC codes, and things of that nature. Given our pedigree, Ken's pedigree raised in mind, the connecting to the tradable identifiers is not a problem for us. So we have that also. And yeah.
How many companies now do you cover, and how many locations, and numbers of data points? It's grown significantly.
Yes, our coverage is global. I even have a deck I can dive into to show the coverage.
Okay.
Coverage is global, and it's universal in terms of ownership structures, ownership types. We cover publics, we cover private, we cover government, we cover hybrid ownership. So as long as there is a physical underlying asset somewhere there, we cover administrative entities as assets such as township, for example, with all the information about this township, including the financials, tax structures, and things of that nature. And in terms of numbers, I think we covered a huge part of S&P 500. We tap heavy in US for obvious reasons because of quality availability of data, but we have pretty good industrial coverage for Mexico, Canada, Europe. We have China, we have India, a bunch of other key players.
Yeah. This is great for credit risk, but also I could see for some of our clients in insurance, real estate, and how are your clients using this to make faster or better decisions? I guess maybe Raymond, we could throw that to you.
Yeah.
Essentially, they were using it. They were looking at, especially in insurance. We worked with a number of insurance companies over the years, and just basically to understand their risk or to understand their clients' risk of what, where their assets are located and what, the geographic risk from place to place. So that's pretty much how they're using it. But we, essentially, there is a use case where folks, they create portfolios, or they have assets, and they have they diversify. They have a diversification of assets that's globally. But what they end up doing, they carry the same risk, physical risk globally. So you might have an asset in Idaho or in wherever it is, but you might be carrying a tornado risk, a demographic risk, and the same environmental risk. So they come to us to understand that, and we tell them where they overlap and where their risks are. Where they're top heavy is like, hey, your portfolio has, a lot, it's carrying a significant earthquake risk. You're diversified, you diversify geographically, but you're carrying the same risk. And then you look at the demographics, and okay, what's the demographic risk? And we see, in disaster recovery, the demographics come into play. If something happens, be it, physical, climate, environmental, the demographics really depends on where you are, really determines how you're going to recover. And we see this over and over again in our use cases and talking to our clients. So,
Right.
yeah, so they come to us to essentially understand some of these risks and to help, they come up with a plan to mitigate it.
Yeah, because you basically have, portfolios. When you think about it, you have your traditional fund managers, your hedge funds, your quantitatives. Then you have your real estate portfolios, but then you even have insurance. But then also, I would imagine people with like supply chain would be like another vertical or area where people can look at the risk of what they have. But that's another portfolio of their suppliers that they're dealing with.
Yes, we do a lot of supply chain risk as well to understand not just your suppliers, but their suppliers to see what their risk are, and how it could affect them in the long run if they're not paying attention. So what we see, in some of these cases is that, everyone essentially understands, their company. They understand what they invest is, they understand the fundamentals, but the location risk is where we have the problems, and that's where we see this opportunity. Whether it be climate risk, whether it be environmental, demographics, and the beauty of our product is, as Alex was discussing, we tie all together the knowledge graph, so you're not looking at these risks in silos, but if you look at the location, go to location, you see the entire scope of what's there, how it could affect you, and we tell you, and we rank these things. What's the location? If you have a portfolio, we can rank it and say, okay, this is where you have your biggest risk based on estimated annual loss, based on what's around you, what's there.
And then if you think about it, what you're doing is you're shedding the light on like the blind spots for people, right? They knew there's this risk there, but they couldn't, equate it or, quantify it before. And then from knowing you guys and talking to you, it's also the technology has now made it possible, right? People have wanted this. And I guess, before we go into a demo, what's made it possible with the technology that we now can do this?
I think that's essentially the knowledge graph system that Ken and Alex have built out over the years. And I'll let Alex go further into that. But I think connecting these disparate data sets, not having them siloed, but have them talk to each other, and connecting these hundreds of data sets together is really that's the key.
Makes it powerful.
Let me add a few things to this. Availability of open data. That's a phenomenon that we started to see 15 years ago. The volume of data published by governments, published by different agencies, published by different players in international space, abundance of this open data. And it's still going on and it's still growing by leaps and bounds. Mm-hmm. Every data set that is in this open data space is created for a particular purpose. And what we do, we connect it so it can be, the combination of those data sets can be used to answer really difficult questions.
Yeah.
And it also brings up, your question kind of pushes another question up, why now?
Mm-hmm.
So typically you have supply, you have demand. We have supply of data and good supply of technology capabilities, like new tools, newer cloud computing, AI, and a bunch of other things. But there is a demand component, which one of the important demand components is tremendous impact and damages that different natural events cause on the industries and people. I'll just mention a couple of, just to put it in a context and perspective. In 2017, Hurricane Harvey hit Texas and petrochemical industry. The damages with those numbers, 150 billion, and the downstream damages. It's not just the refineries in Texas. It's not just people who are flooded in Texas. It's a lot of industries which depend on the products from those refineries. We all remember the cold spell, again, Texas, northern Texas, and all of a sudden we lost natural gas supply to half of the country, or it went down. How do we understand it? How do we understand the interconnectivity of those things and how the damage can propagate downstream? The That's one of the problems that we're trying to address. We're trying to equip people to start. First of all, we want people to understand it's possible to size this problem. It's possible to build those connections, and it's not that difficult if you use the same concept, connectivity of data, and you don't spend hundreds of hours connecting this data sets over and over again when you can go and take it from the shelf and use it.
Yeah.
And I assume it will merge very nicely with a company's personal data set. So if I am, trying to map that data to my internal data, there's APIs and any possibilities there that you want to talk through?
It's a very good and painful question. How do you? It's the same thing. My internal data was created for a particular purpose. It has some legacy of problems, legacy of idiosyncrasies. How do I connect to this beautiful data outside? And given our pedigree, that's what we helping our customers with. First of all, we make delivery very, very simple, like stupid and simple. Just dumping the knowledge graph into your infrastructure is expensive and problem prone, but we can literally cut the flat file to your spec, to your particular use case, code this file with our identifiers and whatever identifier system you prefer and give it to you.
Mm-hmm.
So
You
it's
have all
very,
the, yeah.
With open data sets, I think, we hear a lot about with AI hallucinations and whatnot. How are you ensuring that we can trust that data from the open data sets? What kind of...
well, first of all, we, at least at this moment, we do not consume anything manufactured by artificial intelligence geniuses, right? We consume open data produced by government agencies, some of the players, and it goes through significant profiling and cleansing before it parts in our knowledge graph. So that's a classic way to ensure data quality. You need to understand the data and follow your methodology to catch bad data points.
I think you just brought up a really good point there, Alex, is not only is it coming from these trusted sources, but you also have to clean and check and verify the quality. So you're not just connecting this data, right? You're cleaning it, you're making sure it's prepped correctly, connecting it and putting it in this knowledge graph that's going to then give you this ability.
Yes, it's a great thing. Maybe something that a lot of people underestimate the amount of effort and skills that sometimes go into that particular part of the process. It's a backend. Nobody cares what's going on in your backend as long as the front end looks sexy. But in fact, So example of really big effort that we did was the effort with one of the government databases called Severe Storms Database. It's a great source of data. It's a factual data. It has a good provenance trail, but it was created over several decades, and it carries on a bunch of problems. In order to apply it to today's world, you need to do a lot of work. You need to ensure that the counties and state and the other codes match what people use today. You need to ensure that the damages are normalized. You need to ensure that they're CPI adjusted. You need to fix a lot of spelling mistakes, tons of spelling mistakes. You need to make sure that airports that were hit. Anyway, I can talk for another hour.
Yeah. But what we should do is probably switch to the demo and all that. And there are some questions coming in, and what we can do is answer them as we go through. One is about AI dealing with the map gap problem. Someone's asking for supply chain risk example. And we have also share the types of data being collected, weather events, earthquakes, time frame. And I know, Alex, you have that on all your slides. So why don't we get started and go into the demos here?
I spoke for too long. Back to Ray.
No, you did not at all.
You did not.
You speak.
Perfect.
What's about the data and the data cleansing. I mean, we've been around for a long time, but majority of that time has been in stealth, just working on data, cleaning data, gathering data, make sure we get it right, building out the knowledge graph. Let's say we've been around for 5 years, a little more than 5 years, but I would say at least 3 or 4 years. 3 years of that has just been assembling this data set. So
Okay. All right. Okay. Also, as we go through this one, we have another question. So why don't we get started to go into like some of what we're going to do the show and tell, and then I think people are also asking about identity resolution when you're mapping a third-party data, open, proprietary, or to in-house. So yeah, we'll just have the questions keep rolling in here. All right, guys. And I don't know if it's Alex's slides or Raymond's demo with the portfolio.
I will push to Ray because I'm afraid that I'm gonna
I'll do
overextend about them here.
Yeah. Okay. Ray, take it away.
I'll do a quick. Let me see if I can. Let me share. Excuse me.
Yeah.
Let me know when you can see my screen.
I will do that. Hold on one second.
We're in.
There we go.
All right. So this tool, Spatial Risk Queue, is basically this off-the-shelf tool that you can use. And we build, like I said, we look at things at many geographic layers. You know, be it county, state, city, tracks, whatever. We can draw boundaries. We can do whatever we want. But for most folk, most people understand zip code, postal codes. So we basically built a tool around postal code where you can look at where your location of your asset is, upload your postal codes, and get the risk profile of that portfolio. I have, for demo purposes, I have two portfolios loaded, two separate portfolios, 50 location, and this is the amount, 5.9 billion, average risk score, and let's go take a look at the portfolios. So this tool basically analyzes your portfolio, right? Oops, I didn't want to do the map. I'm going to go here, run a clean analysis, and there's a button here that you create your portfolio. You create a portfolio, you basically upload a file, a CSV, with the zip codes of your portfolio and the value of that portfolio. So very simple process. And you hit the analyze button, and it gives you your risk profile. So now this portfolio, you can see, the hurricane risk. There's 14 of this, 35 names in this portfolio. 14, is in the high hurricane risk. The rest, earthquake, tornado. It just basically breaks it down, and it gives you a high risk location, and it gives you the value down here. You can see where hurricane. 78% of the portfolio is in a hurricane zone, and then you can go and look and see where it is. What the risks are. These are low. Some of these are low risk. You can change it to this high risk portfolio. Let's want to see what's on high risk. So then it changes everything. So now we consider everything above a 6 a high risk. So now Cambridge is no longer there. So these hurricanes. So basically is breaking down the portfolio by your different risk factors. So you'll know what's there, what's the percentage of your portfolio that's at risk, and the value of that portfolio. So that's your climate risk. And we look at the environmental risk around that portfolio as well. What's there, EPA sites, toxic release, and we're tracking hundreds of environmental risk factors that would affect a portfolio. Like when there's an event, we find that the environmental factor comes in next, because what's that climate event or whatever it is spewing up, and that's the environmental things. Whether it's Superfund, the EPA facility, toxic release, we rank it on the portfolio. Then we basically do a percentile ranking of the portfolio against itself. And we look at what's which part of your portfolio has the highest risk? And here is for this demo portfolio, Springfield, Missouri. You can see where it has all the fun stuff that could affect it. So basically, it's ranking it among itself, so you can see which part of my portfolio, and you can look at it. This is overall risk. If you just want to look at specific risk factors, you can do that as well. But overall, then. And moving through this fast because we don't have a lot of time. But then we have you can do time projections, the portfolio. You can look at different climate scenarios. You can create your own custom scenario if you don't. What we have here is things middle of the road, conservative, severe emissions, and you can look at it over time, or you can create your own custom scenario. If you have your own view on things, you can do that as well. We also have, I won't go into these now, but we also have weather alerts and different kinds of reportings. So, and then again, demographics is important. So we look at the demographics of what the portfolio is like, what's affecting them, demographics, the housing supply, healthcare. We rank it and we break it down. We look at the different things that go into this portfolio. So if this was a different portfolio, you'll see different things here. And then we have a location card that tells you about the location. And then we look in we have a view, if we're doing this for a while, so we have a view of the recovery the portfolio. So we look into the locations as unlikely to recover, difficult, and that's based on, and really this is just based on demographics. This is our people metrics part of the tool, and so it's just looks at each location. And again, this is our view based on what we know, based on what we see, and we look at the locations unlikely to recover and why we think they're unlikely to recover if there's an event or you take a loss. And so that's pretty much it for that. And then of course there's a map.
Oh, the map.
Go ahead. Yeah. So anyway, that's it in a nutshell. It's a tool designed around zip codes to give you what you want. We'll add different layers as we move forward. Like I said, we can operate at any geographic layer. We'll add other things to it, but this is an off-the-shelf tool to come in here, look at your portfolio, look at portfolio risk, look at environmental risk, look at demographic risk, and look at physical risk and understand what's in a location. And again, it's very easy to use. You come in here, you upload your portfolio, or you can like I said, you can upload the CSV, or you can manually enter your portfolio, give it a name, and that's it.
Are we able to see the map? Just could you demo that just briefly?
Yeah. So this is just a simple map right now. This is just your portfolio. This is one of my portfolios. It just goes to the location, and if I want to look up specifically, if I want to look up an area, like say I want to look at San Francisco, I can just type it in and look at these locations in San Francisco. It gives me the risk around there. But this is basically a map view of your risk of your portfolios. I'm looking at both of these. This one portfolio right now. But yeah, this is essentially what it does. You can search different locations.
Yeah, this is great.
Yeah. Okay.
That is fantastic.
Very good.
All right. So then I think we have handed over to.
Yeah, and I might have talked too fast through that, so anyone can reach out to us, and we'll give them a proper demo when we have more time and go through it.
No, definitely. And then, then you're able to also, I think one thing we didn't really quite know for people was, you can then those can go back to the securities that someone owns in their portfolio, so they know what is tied and has the risk to it.
Yes. Yeah, you can definitely tie back to your portfolio. It's a portfolio tool. You upload your portfolio. There are different layers to this. This is just one layer. We'll add different layer. Yeah. How often there's a question, how often is secure environmental data collected? I think we refresh our data. This is slow data, and we refresh it quite often whenever it comes out. We'll make sure it's correct. We'll look at it. But yeah, I think Alex will probably have a better answer on that. Go ahead, Alex.
Are we shifting to the data or to the questions, or?
Yeah.
I would bring it up and we can then we can kind of answer the questions throughout. I think you guys can probably even explain as Alex, as you go through, for example, I do know they're asking if you're relying on satellite data. And I know you guys go and you get the physical assets first and you start there and then you marry the satellite down. So I think some of these we can answer as we go through this.
All right. So let's see what question number one, map gap problem. I don't quite, let me guess what map gap problem is, which is probably the latency related. Maps typically are delayed, sometimes unless you buy real or close to real-time maps, and it's very expensive, or if you use stock maps, they could be as old as 2-3 years, if that's the map gap problem mentioned here. So it really depends on the problem that we're trying to solve. The data about physical assets, most of the data comes from the government and comes from agencies like EPA, Energy Information Administration, and a bunch of other agencies, and it's driven by the reporting standards. For example, lots of data about physical assets is connected to the permission process. When somebody wants to build a data warehouse in the middle of nowhere in Louisiana, before they actually do anything, they will file for permit, and this permit gets reviewed, approved, and the data will trickle down into a federal databases or state databases, and that's where we're picking up the data from. So there is a latency related to that, but it could be better than certain maps, unless the customer has resources to put a satellite right on top of this particular spot. But in order to do that, the customer needs to know where the spot is. Anyway, it's a pretty long-winded answer. I'm not sure I answered the question, but that's what I have. Question number two.
Let me just read it. So we have, could you provide a sample, a supply chain risk example?
There are lots of things here. There are several things related to supply chain. Let me start with this one. That was actually asked from one of our prospects, a global food manufacturing company. They buy a lot of dairy products, and they would like to understand how their supply chain would be impacted by different weather-related factors. So, since we know basically the location of every farm of certain significance and up, in this particular case, we're focused on dairy manufacturers. So we have the map, we have the location of those guys, and we can easily associate their locations with particular risk profiles. And that gives us ability to offer this customer that picture. And based on this picture, they can decide how they're going to deal with that, whether they will diversify their supply chain by opening a relationship with suppliers located in less risky areas, or they simply inform their suppliers and hear from them what they think, how they can provide resilience measures to ensure the quality of supply. So that's just one of the cases. There are probably much more interesting ones. We hold the full sector of our knowledge graph focused on companies that sell products and services to federal government. Specifically, we focused on defense, so we can build literal supply chain from tier 1 to tier 2, tier 3 suppliers. And again, connected to other factors that we have in our knowledge graph, we can build a picture of risk to a particular defense program, exposing the risks upstream in their supply chain.
Very cool.
All right. That's another one. That's probably the question du jour. With a rapid and huge investment into the AI infrastructure, we would like to understand better what's going on there, who's supplying to whom, and how the risks to those huge projects propagate from upstream to downstream. In this particular case, in this real case, we'll look at the major extension of one of the companies that it's actually called Skyworks, and their main manufacturing facility is in Mexico. They built a huge extension to their plant. They own large part of the market for G5 modems, basically, that you'll find in every cell phone. And we identify suppliers to that company. And the list on the bottom of this slide will tell you who is supplying what. The interesting part is how we did it. So Ray has already mentioned the concept of slow data. Slow data is a bulk of what we have in our knowledge graph. The data that is important, that can solve lots of problems, it doesn't change quickly, it doesn't change a lot. It changes slowly. Like demographics, like socioeconomic makeup, environmental conditions don't change every day, don't change every week, don't change every month. But there is a fast data. And what we find when we connect our slow data with fast data, such as truck traffic, vehicle traffic, food traffic, mobile phone traffic, weather alerts, satellite observation for that matter, we can uncover a lot of interesting insights, a lot of interesting things, because slow data gives good context and fast data gives you an idea about what's going on right now. So in this particular case, we partner with one of the major providers of traffic data, and we were able to identify the places where the deliveries are coming from, and on top of it, main activities at those places. Again, references back to our knowledge graph with all information about physical assets and activities that are performed at those assets. And that's how this picture was created.
So those trip counts there are those the delivery truck deliveries that are coming and going to the site.
That's good. Yep. And we can track, I wouldn't call it real time, but reasonably quickly with low latency. I think the current latency is about slightly over 1 week. So that it's an interesting opportunity for a bunch of people who are have financial interests in monitoring this industry.
And then related to like semiconductor would be also like there's, in the whole trend that's going on is like the AI data centers and things like that. You guys track those as well.
Absolutely. That's absolutely correct. Let me see. Yep. Using the same methodology, connecting the fast data, with slow data, with our physical asset information, we can identify the structure of supply and see the progress of construction across multiple sites. And we also see the intensity of construction, literally by inferring the times where those trucks are coming and going. If they go during normal working hours, that's normal, that's okay. But if they also go during the nighttime or during the weekends, we know about this. And we build intensity factor that will help people to understand how intense construction is.
So this can actually let somebody kind of monitor the construction progress, whether they could be a competitor and get to monitor that, or an investor.
I think it's quite possible without data.
Yeah.
All right, so let me stop here. Let's go back to questions. Ray, do you want to take on any of those questions?
No, but I'll add to the supply chain thing. I mean, we saw a few years ago in the Texas incidents that a lot of manufacturers that relied on chemicals from Texas were surprised. Some of them didn't know. A lot of suppliers didn't know that they had these risks, these climate risks, because they didn't think about where the supplies were. So now we're seeing a lot of that where folks are paying more attention not only to their suppliers but to their suppliers and see their full risks, so to speak.
I think people also are asking like the type of event you follow, even if you do cover man-made risks as well, such as civil wars.
And also
Could be an oil spill. I'm trying to think.
So what they're also asking what types of data, so e.g. weather events, earthquakes, fires, recovery time frame, post recovery.
We do 18 types of physical climate events, earthquake, tornadoes, I can't think of them right now, but cold, all kinds of flooding. So basically all the major weather events. We track recovery based on demographics and what's there. We look at the demographics and we marry them together to see, and we can have a fairly good idea of how someone will recover. I mean, if you look at, say, something like Superstorm Sandy in New York and the quick recovery there, based on the demographics of the city, a young population, very upwardly mobile population, and based on what's there, as opposed to somewhere like, say, New Orleans when they had their event, it takes a longer time. So that's all demographics. That's all based on who's there. You look at certain fires in, California or wherever, quickly we can look at it, okay, what's there? And we can look at the demographics, you cover that, you marry that with the demographics, and you can predict fairly accurately how long it will take to recover based on that. So yeah, it's a matter of looking at everything, not in a silo, but looking at all the information. Looking at your physical asset. What was the event? Looking at your environmental. What's around there? What does the demographics look like? And all those together work.
And then would you so I'm just being a superstorm Sandy survivor myself. Would you then also tie in like the government, the way that they came in with their recovery funds and said all right, this is hit the entire East Coast. We need to does that get factored in, the government help that goes with these guys?
It does. I mean, it does in a number of ways, and I'll let Alex take the second part of it. Yeah, when you look at to navigate, demographics play a part in the fact that if you navigate the government paperwork, you need a certain, it's difficult. It's not easy. It's not everyone that can do it. So it's the guys who can go in there and look at it, figure out what these the stacks of paper will be recovered quicker than someone maybe language barrier. It could be all kinds of things. It ties back to demographics, and we look at that as well. We'll look at is there a barrier to English? These are all demographic factors that no one really thinks about, but it's there and it's in the data. You can infer certain things with this. So
yeah, it's interesting.
Alex,
go ahead. I'm sorry.
Sandy, it's a very good question, and I'm also a survivor. I was there, and we went to our friends with our dog for a week because we lost electricity. So I'm survivor as well. So talking about how we can assess resiliency, that's a very good question. So we have data that can help people to assess it. Ray already mentioned demographics. Unfortunately, demographics is very slow moving data. The actual changes may happen quickly, but the data comes in on annual basis at best, and it's also sampling type of data, so it's difficult. There are other data sources that are part of our knowledge graph that I think could be much more effective. Number one, and I think you mentioned it, is a information about federal assistance that comes from agencies like FEMA, SBA, and few others. In fact, this is very significant cash infusion into the local economy. It's helping people, and it is not reflected, this type of assistance that goes directly to individual and businesses, it's not reflected in financial reporting of the local governments. Right. So we have both. We have data from local governments about their finances, their taxes, and data about federal assistance. And that helps to assess, let's say, data about taxes, how much taxes they collected before and after, and how quickly they recovered their tax base post-disaster, and what role of federal assistance plays in this process. That's where this interesting interplay takes place, and we have the data that highlights all of it.
Interesting. It's and really interesting. I think one of the factors that they said delayed everything in terms of recovery was just that 1 million trees were down, and you'd have to get the people to move the trees first and make sure that the wires weren't touching the tree. I mean, that was really like the biggest factor, I think, in the speed for recovery for Sandy. So it'd be really
there are different types of recovery. There's a recovery immediately when you start getting power in your house. That may take a week, may take a day, may take 2 weeks, whatever. But there is a macro recovery. What people reaction to this type of disaster? Are they finally considering improving their houses, resiliency of their houses? Are they municipalities investing into the flood control measures? Those are more macro factors, and they have huge impact on the damages going forward.
Yeah. There was I think I'm out in New Jersey by the Jersey Shore, so there was, everyone had to raise their houses. I would imagine, the Palisades and California fires are now having like a similar thing where they're having, when they rebuild, they have to do fireproof, that type of thing. Would you be able to speak to the approach you take to identity resolution when mapping third-party data, either open or proprietary, to in-house data?
Yep. What I can say is that Ken, who is our CEO, spent, I think, few lifetimes doing exactly that. He built a product last year that he sold to FactSet that's precisely focused on the ownership chains and stuff like that. I spent also a big part in Dun & Bradstreet building the family linkage products. So we understand the challenges there. That's number one. Number two, in many cases, it's what I would call trench warfare, when you really need to have a group of people, highly professional, very well versed in understanding how ownership could change and when it can change and how it's reflected downstream. So we have this group of people, and what happens quite often, we get ownership information, and then our data research folks go and literally collect data about the change. Sometimes so it's a warfare, it's a fight. And the approach that we taken is it's a combination of machine work and combination of people work, working in tandem. Second principle that we apply is that we do quality control on top of it, obviously. The third principle is we focus on what matters the most. So we focus on the players that either take big percentage of the market in certain industries or big impact for other reasons. So we look at this to prioritize our work. Otherwise, it's never ending type of project.
It's like being in a gunfight, Alex. You're in a gunfight.
But it's slower than gunfight, but it's still painful.
A slow gunfight.
Yeah, slow gunfight. Love it.
Next question, is it reliant on satellite data?
Well, as I mentioned, satellite data is helpful in a number of use cases. What we actually will start focusing on as a source of fast data. So we can see what's going on much more frequent time frame than what we have with slow data. And that gives us an idea about both the levels that we can trust slow data and also collect information about progress of production, of progress of construction of different sites. And another thing I mentioned that we started combining fast data with slow data, and just one source of fast data cannot give a sufficient, in many cases, very high level of confidence in the results that we're getting. So we will start collecting multiple types of data. So let's call it synthetic view at the site. So we'll start collecting traffic data, start collecting the satellite data about the sites, hopefully in combinations that give us a much higher confidence.
Also, we wanted to ask, does your risk analysis support multiple use types within the property? For example, in a mixed-use building that includes residential units, storage space, and a storefront, can the model evaluate and weight the risk separately by each type of use?
That's difficult.
Yeah.
That's
The
an
damages
interesting one.
that we are relying on are mainly reported by insurance assessors and fire departments, police, and simply reporters to NWS. So quite often those damages do not reflect the business damage or damage to businesses or damage to business property. So it's a very difficult piece of info to come by. Insurance companies are not that quick to share this data. So that's a challenge.
Yep. Is there one more?
I think we're right at time.
We're almost at
Oh,
time
wait,
here. Yeah.
one last one here. Are you able to gauge the severity of impact from a weather event based on the nature of the asset? E.g., a retail store is impacted by inclement weather much more than a data center.
Yes, we expect that the retail sector will be impacted much more and faster than data centers because data centers are built with significant investment into the resilience and protection. Just very hard industrial buildings, unless people make stupid mistakes, which could happen, but I wouldn't place high probability on that. And retail is damaged simply by the fact that people, on one hand, they're busy with other things rather than buying new couches. On the other hand, they are buying new houses because they need to replace the flooded furniture. So that's what we can see is based on the tax data that there is a spike in the year following major disaster in taxes related specifically to the new construction and recovery efforts.
So I think we're at time. I mean, we've had a lot of questions, a lot of interest here, which has been great. LinkedIn.
We can be contacted in LinkedIn. That might be
LinkedIn.
easiest. Drop us a
And then
line. Well, we have, they can just come to our website, Spatial Risk Systems, see what we have there, or they can come to where our app is, Spatial Risk Q, and take a look there.
We've been delighted to have them on the show today. Just to kind of quick tee up what next month on Office Hours, episode number 6, and our final episode of the year will be on December 9th at noon with the CEO, Ashish Mehta.
From En-ROAD.
Ashish has been a serial entrepreneur in services for the last 25 years. His firm actually goes and he collects the data and extracts it from long-form documents for financial services companies, private credit, banks, asset managers, and so forth. And we're going to be delighted to have him talking about what he sees the trends in the market and going into AI, what financial professionals need to know. Thank you.
Thanks so much.
Bye, guys.
Thanks, guys.
Thank you for hosting us.